A sudden shift is forming in the AMC story, a shift driven by market structure, trading behavior, liquidity conditions, and institutional positioning. Today, we break down what's actually happening beneath the surface of AMC's price action and why this moment may be more important than it appears. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. But everyone, remember, this is not a financial advice video. AMC continues to be one of the most closely watched tickers in the market, especially among retail traders who follow market structure, off-exchange activity, liquidity trends, and institutional accumulation patterns. In this analysis, we'll examine recent data points, industry developments, and broader market conditions that may be influencing how AMC trades today. This discussion does not provide financial advice and does not make guaranteed predictions. Instead, it focuses on publicly observable trends, data-based interpretations, and market mechanisms that traders often monitor. One long-running topic among AMC observers is how institutional buying and retail buying interact over time. Historically, retail interest in AMC has remained strong across many price levels, while institutional reports periodically show changes in their holdings. Recently, some analysts point out that despite periods of price decline, institutional filings show increased ownership. This indicates that large financial firms may be adding to their positions when the stock trades at lower levels. Although opinions vary on what this means for AMC's future, it highlights a pattern where institutions accumulate during periods of broader selling pressure. Some traders also discuss the idea that when price declines, it may create opportunities for institutions to buy shares more cheaply, especially if long-term investors believe AMC has potential tied to its industry recovery or future entertainment-related growth. The debate here is not about certainties, but about contrasting interpretations. Some view price movement as a natural result of supply and demand, while others point to deeper structural factors like liquidity, volatility, and trading venue differences. Another point frequently discussed is the topic of synthetic or derivative exposure connected to high-volume stocks. Public filings and market mechanics make it clear that options activity, swaps, derivatives, and various hedging tools can create complex layers of exposure beyond the traditional float. While numbers cited online vary widely and often include speculation, the general concept traders focus on is that derivatives can create temporary imbalances in buying or selling pressure. Importantly, none of this confirms precise hidden share counts. Instead, it shows that certain stocks experience heavy derivatives usage, leading to heightened volatility. The conversation around AMC's authorized share count is another area with two sides. Authorizing additional shares does not automatically mean dilution. Shares are only dilutive if they are actually issued. In theory, expanding the number of possible shares can provide a company with flexibility for fundraising, debt management, or future opportunities. Some investors worry about potential dilution, while others argue that if the capital raise strengthens the business, it may ultimately support long-term stability and growth. The correct perspective depends on how the company uses the flexibility. In the past, AMC has used offerings to raise cash, reduce liabilities, or invest in strategic opportunities. Some market watchers believe that if AMC had additional funding earlier, it might have expanded investments such as the company's involvement with HYMC. Recently, filings showed additional purchases of IMC shares by outside investors, which creates conversation about how interconnected sectors like mining and entertainment can influence each other through cross-investments. Another topic being discussed widely is trading venue distribution, specifically how much of AMC's daily volume occurs off-exchange. Public data from FINRA routinely shows that a large portion of trades in many popular tickers execute through off-exchange mechanisms such as wholesalers and ATS, alternative trading systems. This is not exclusive to AMC. It is a structural feature of U.S. equities markets. However, some investors argue that high off-exchange percentages can reduce the visibility of true supply and demand on the lit exchange, potentially leading to a price that doesn't fully reflect active buying interest. Again, this does not confirm manipulation. It simply highlights how modern trading infrastructure can affect price formation. Comparisons are often drawn to other companies experiencing similar patterns, such as Genius Group, which has been publicly engaged in regulatory and legal processes regarding their concerns about trading activity. Observers sometimes link AMC and GME into broader conversations about liquidity, transparency, and modern market mechanics. What matters for this analysis is not assuming guilt or wrongdoing, but understanding why certain traders monitor off-exchange percentages so closely. Recent discussions also highlight the concept of liquidity stress in global markets. When the broader market experiences rapid declines, such as days when large-cap tech stocks move sharply lower, or when total market capitalization decreases by hundreds of billions, it creates ripple effects. Liquidity challenges can cause institutions to rebalance portfolios, reduce leverage, or adjust positions across various sectors. For heavily shorted or heavily traded stocks, this type of environment may amplify price movement. In one recent session, the U.S. market reportedly saw more than $1 trillion in value erased, while the crypto market also experienced a significant drawdown. These are major macro events that can affect collateral levels and margin conditions throughout the financial system. AMC and GME watchers often pay attention to this because liquidity tightening can impact leveraged positions, both long and short. A related global factor is Japan's bond market. Rising yields in Japan can influence global funding strategies, such as the yen carry trade, a strategy that benefits from low interest rates in Japan. When yields rise sharply, certain leveraged global strategies can unwind, creating additional volatility. Some analysts suggest that large financial institutions with complex exposure to these strategies may feel pressure, which can indirectly affect how they interact with U.S. equity markets. Other data points center around legal actions or regulatory processes that involve various trading firms. Some high-profile companies, including market makers, have faced lawsuits from different corporations alleging issues such as spoofing or improper trading behavior. While lawsuits do not confirm wrongdoing unless proven in court, they do illustrate an increasing willingness among companies to pursue legal clarity regarding trading activity. For AMC followers, this creates an environment where market transparency is a recurring topic. The reverse repo facility is another metric traders watch. When usage rises, analysts sometimes interpret it as financial institutions seeking short-term liquidity support. When usage falls, some interpret it as fewer cash surpluses in the system. Recently, reverse repo usage increased from around $1 billion to over $6 billion. Rather than viewing this as a sign of strength, some analysts interpret higher usage as institutions temporarily needing liquidity. Regardless of interpretation, these fluctuations often shape discussions about market stability and short-term risk sentiment. One of the most important things happening right now is the shift in how the market views major tech companies. NVIDIA, which has been one of the strongest drivers of market gains, recently saw a sharp reversal after earnings. Although the company delivered strong headline numbers, deeper reading of the report led some investors to reconsider the sustainability of current growth rates. That reversal contributed to widespread selling across the market. In situations where tech leadership weakens, the entire market can become more vulnerable. There has also been discussion around high-profile partnerships and whether certain expected agreements will materialize. Speculation around NVIDIA's potential partnership with OpenAI created significant excitement earlier in the year. But recent reports suggest the agreement may not yet be finalized. This raised uncertainty that contributed to selling pressure. The combination of global liquidity pressure, bond yield movement, large cap volatility, legal scrutiny involving market makers, high off-exchange trading percentages, and institutional accumulation data all intersect in the AMC discussion. While none of these factors individually dictate AMC's future, together they paint a picture of a market environment undergoing stress and rebalancing. AMC's possible upside in the future, according to some analysts, comes from two areas: reduced structural suppression if liquidity constraints tighten across leveraged positions, and the possibility that price could adjust if off-exchange volume eventually decreases or if market conditions force more trading onto lit exchanges. Additionally, speculation around high price levels like $1,000 or $4,000 per share is not based on guaranteed outcomes. Those numbers often come from hypothetical scenarios that assume extreme liquidity events, short covering cycles, and high demand. While these scenarios are theoretically possible in rare, highly stressed environments, they should not be treated as predictions. They are simply models used by some traders to illustrate what could happen under very specific conditions. Overall, AMC remains a high-attention, high-volatility stock shaped by a mix of retail enthusiasm, institutional positioning, market structure, and macroeconomic pressure. The path forward depends heavily on liquidity trends, off-exchange volume, regulatory developments, and the broader market environment. As always, investors should research independently, stay aware of risks, and understand that no outcome is guaranteed. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.